All right, so I'm going to run through this 2017 tabular statement question. It is a 100 mark question, so this one's slightly longer tabular statement questions. I'll go through it. You can see there's about, I think, about 11 months here that you'll be doing. So I'll go through it maybe 3-4 months at a time. I'll break the video up, so it's not just one long continuous video. So first thing you do with one of these questions is you copy this balance sheet out into your tabular statement. Okay, so I'm just going to do this on Google Sheets on a spreadsheet because what you will be doing in your copy will look very similar to this. Okay, so just with stuff with the fixed assets, it's not the net book value you put in the cost, and then you put in the depreciation as a negative asset when you're copying those out. So rather than putting in 605, the value of the land and buildings, I put the 630 in, and I put in the minus 25. Okay, so I do the same with vehicles. We see there it's 50 and 27, so I put in 50 and minus 27. All right, same with equipment. Stock, I'm just taking straight from the balance sheet. And then so it's the trickiest one here when you're listing them out, the debtors, the 86,400 euro here for debtors is already after a provision of 4% has been taken away. So that 86,400 is debtors take away 4%. So I'm going to show the debtors and its provision just like I showed the fixed assets. Okay, so rather than just putting in the 86,400, I'm going to figure out what was the debtors amount and then what's the 4%. Okay, so the way to do that is that 86,400 is after 4% has been taken away. So that's like 96%. So if you take the 86,400, divide it by 96, and then multiply it by 100. That's getting you back to the debtor's figure before you took away the bad debt provision. So dividing it by 96%, because it's after a 4% provision, and then multiplying by 100, and I get 90,000 as the debtor's figure. The bad debt provision then just get 4% of 90,000, and that's your 3,600. Okay. The liabilities then, so this will be everything in the creditors and obviously everything down here in the financed by. So you're putting in the issued share capital, the share premium, the profit and loss, and then these 4 items here in creditors, they're just going directly in. There's no adjustments to be made there. There's no negative liabilities that you need to put in. The one thing we're going to need to watch is bank is down here, so that can kind of make the flows in and out of cash a bit kind of trickier, a little bit more to maybe require a little bit more thought when we're doing movements of cash. But that's everything. You're totaling your assets, get 799,400. You total your liabilities, you get 799,400. So they balance. Okay, you're splitting them up a little bit different to the balance sheet, so you're not getting the 699 because you're adding the creditors to this. So 799,400. You'll see there the 100,400 plus the 699, that's the 799,400 that I'm getting. Okay, but your assets and your liability should add to the same amount. Don't forget to leave a couple of lines, maybe 3 lines if you're being prudent, to put new assets in or to put new liabilities in. All right. I think then I have a transaction for every month except I think May is missing. I think every other month is in there. So I just have a heading for each month, skipping over May. And then December I put in twice because December is often one where you have a couple of things going on. You will have a transaction for December, and then there's often something here where you'll have to maybe close an account or deal with some prepayment or an accrual or something like that. So that's why I've put in 2 headings for December, and then just the total or what it is at the end of the year, the 31st of December 16. All right, so that's just, as I said, copying down from the balance sheet in the question. So we'll start getting into the transactions then. So January, Delaney decided to revalue land and buildings on the 1st of January at €800,000. The land element of the new value is 110,000. Okay, that land element I'd say will come in later when we're doing depreciation. We don't need it for this transaction here in January, but I'm revaluing my land and buildings at 800. Okay, so I have my land and buildings in at a cost of 630. So just 800,000 take away 630 is €170,000. So that's what you're going to add on to your land and buildings to make them equal 800,000. Okay, so we're increasing the value to 800, so we're going to add 170,000 onto them. All right, if we are revaluing them at 800,000 euro, we're going to get rid of all that depreciation as well. Okay, so there's no point in revaluing it at 800,000 and then immediately taking away depreciation, saying, oh, its value's gone down by 25 grand. No, it has been revalued at 800. That is what we are saying it is worth now. So I'm going to get rid of that depreciation by adding the 25,000 on, because that's a negative number. Okay, so what I've done now is I've added 195,000 onto my assets. All right, whenever I revalue something, what do I create? A revaluation reserve. Okay, so you'd put a revaluation reserve down in your financed by on your balance sheet. So I'm going to put in the revaluation reserve down here. Okay, and that is 195,000. So now I'm adding 195 to assets, I'm adding 195 to liabilities. My accounts are still going to be balanced. All right, and that's a really common one that comes up and almost always comes up in the first month as well in these questions. Okay, so just a revaluation. So you're changing the cost, you're adjusting the depreciation as well. Whatever it adds to, you're putting that in the reval reserve then as well. Another really common one of these questions then, acquiring a business. So on the 1st of February, Delaney buys an adjoining business, which includes buildings that cost 180, equipment of 50, debtors of 12, creditors of 20. So we'll add all those in. That's the first thing we'll do. So we've acquired buildings worth 180. So that's going to be added on to my buildings. Equipment of 50, debtors of 12. So just add 50 onto the equipment, add 12 onto the debtors. And it includes creditors of 20. So another 20,000 into creditors. Now, the purchase price was discharged by granting the seller 200,000 shares in Delaney at a premium of 20 cents per share. So let's go up to these shares. So we have authorized share capital of 800 and issued of 560. So we are issuing another 200,000 euro of these shares that cost €1 each. Okay, so I'm going to add 200,000 on to my share capital. Okay, so another 200,000 euro, or 200,000 €1 shares are being issued. So that's another 200,000 being added on to the share capital. And what else is going on? That's at a premium of 20 cents per share. Okay, so we're not saying the shares are actually are worth €1. That's like their nominal value. We're saying they're worth 120. Okay, so the 20 cents that's going to be recorded in share premium. Okay, so it's 200,000 shares we've issued, 20 cents of a premium on each one. So share premium, you're going to do 200,000 multiplied by 20 cents is another 40,000 of a share premium. All right, so that's all we're told about in the transaction there in February. But what you'll notice is your assets add to 242, your liabilities add to 260. So there is a difference there of 18,000 euro, and that is what we call goodwill. So we're going to add in a new asset called goodwill. That's an intangible fixed asset. Okay, so you will have seen it in final accounts questions. And this is how goodwill is created. When you buy a new business, it's worth a certain amount, but you pay more than it seems to be worth. Well, then you're buying the good name of the business, or you're buying like their customer list or something like that. And rather than we're not able to put an actual value on it. So the difference between what the business is worth and what we actually pay, that's goodwill. Okay, so just whenever you have acquiring a business in one of these questions, this will come up. Okay, and the difference between the assets and the liabilities, that's added on to assets, and that's goodwill. All right. Next one then, in March, management decides that the provision for bad debts should be increased to 6% of debtors at the end of March. Okay, so just be careful here. The debtors at the end of March is the 90,000 plus the 12,000. All right, so the debtors are 102,000. All right, so just doing maybe a working over here or the right hand side, 102,000 multiplied by 6% is 6,120. So that's what I want my bad debt provision to be. All right, my bad debt provision is currently 3,600 euro. So I'm going to add on to that bad debt provision to make it equal to 6,120. All right, so just the 6,120 and the 3,600. Yeah, so another 2,520, okay, of a bad debt provision is going to make that equal to 6,120. Okay, so the provision is 6% of all your debtors, so the 102,000. So the new provision is going to be 6,120, but you've already got a provision there of 3,600. So you're just adding on here whatever will make the provision go up to 6,120. So I might kind of include that over here as maybe a working down the end. I'll just get rid of it for now. All right. So 2,520 of an increased bad debt provision. Okay, so whenever we increase or decrease a bad debt provision, where else does it go? It goes in the profit and loss account. Okay, and if it's an increase in a provision, it's an expense. If it's a decrease in a provision, it's other income. Okay, so in this case, my provision's going from 3,500 to about 6,000. So that's increasing your provision. So that's an expense. So that 2,520 increase in bad debt provision will be an expense. So you would take that away from your profit and loss account. Okay, and you'll see there, you're taking 2,520 from assets, you're taking 2,520 from liabilities. So you're balanced there. All right, so that's the laying out the assets and liabilities at the start, and January, February, and March's transaction done. I will leave this here and do the next few months in the next video.